Let's kick off very quickly, have a chat about the RBA. No surprises there in the statement, but certainly the market seemed to like the gist of what it had to say.
Yeah, obviously the removal of a language around inflation peaking at 7 and using the Treasury 7.75, removing terms about removing emergency accommodation and now moving towards normalisation, and also language around no set path, i.e. stealing from Jay Powell's songbook and being data dependent. So probably means that the door is open for less than 50 bips. So don't be surprised to see some 25s coming out, maybe taking the cash rate up to 2.6 by November and then pausing before maybe even falling the second half of next year. That's kind of the house view at Shaw and Partners. The market is a bit more aggressive than that, suggesting probably 3.25 is the peak. But certainly just, you've got to look at the statement the month before and this statement and look at what's been taken out and what's been replaced, and certainly a lot less hawkish anyway, and a lot more of a view that they are approaching, not quite at, but approaching a neutral setting.
Yeah, you mentioned that using the playbook of Jerome Powell there in the United States, the Federal Reserve Chairman, that's going to put a light under a lot of those US equity markets and also help to go and mitigate some of those concerns that were permeating about the reporting season there. Now that we're more than halfway through that particular event, what have you made of the earnings results that have been reported?
Yeah, it's interesting, the surprise level, which is the proportion of company results that have come out that have been outside market expectations. It's not fantastic. Here we've got the last sort of 9 quarters, including the second quarter to the right there, and you can see it's about a 5% surprise rate, which is not, it's not great, but it's not at recessionary levels either. And the number of beats of that 5 is running around that sort of high 70s, 80% level, which again is pretty solid. It's not sort of knocking the park out like we were 12 months ago, but it's kind of okay. It's not bad. It's not good. I don't know if you can go to the next couple, which just show, I suppose, the longer term trends on these things. Yeah, so these are looking at the quarterly beat rates over the past 20 years, and you can see that during recessions you get negative beat rates. You don't get positive beat rates, and the number of negative surprises is typically sort of 35 or even 40% during the GFC. So having 20% negative out of 5% is not really recessionary level. So I think one of the big fears everyone has that this reporting season was going to be a disaster, not necessarily on the numbers, but on the guidance. I think that's proving to be incorrect, and maybe the economy is a bit more resilient than worse fears, and obviously the narrative of central banks plays into that. So where's the market pricing cash rates in Australia? That's probably the most important thing for people out there, because there's a couple of $1 trillion of mortgage debt in Australia, and some of that's looking to reprice, etc. We've shifted dramatically, Scuddy, from even 6 weeks ago on the 15th of June, just before the Fed 75-point hike. We're at 4.43 maximum cash rates in the middle of next year. We're now looking at sort of 3.3 at the start of next year. So a dramatic change in the interest rate expectations of the Aussie market, and obviously the Fed and now the Reserve Bank getting less hawkish is helping to play to that narrative.
So financial conditions ever so slowly starting to go and loosen a little bit here domestically, as we're seeing in other parts of the world. Going into our reporting season here locally, what are your expectations? Some of the early results, when you miss, the markets are just punishing share prices. I thought we're already past that stage.
Yeah, no, the market's been brutal. Some of the small caps that have even come out with upgrades. We saw, United Malt Group the other day get absolutely tanked. We saw Aussie Broadband get belted. Today we saw Appen get absolutely smoked. I mean, Appen was in the ASX 100 not that long ago and $40 a share. Today it's $4. So the market is pretty brutal with anything that misses. And obviously avoiding landmines during reporting season is probably the way we need to go. But I think the fears around, rising costs, labour costs, input costs, impact on margins, labour shortages, and supply side, and whether or not the demand side of the equation is being impacted by cost of living. They're the sort of 3 or 4 factors that everyone's worried about, and companies have that in varying degrees. I think the ones that are really, really bad are probably pre-warned. They're kind of legally required to pre-warn. So, we've seen a lot of landmines already, but don't be surprised in the weeks leading up to reporting season, you get a few more of these.
Just on a company like Aussie Broadband. Now, you talk about tough economic times, tight in the belt and whatnot. That sort of implies that people are likely to go and stay at home more often and maybe like try and entertain themselves at home and maybe not spend as much out in the like. Wouldn't that go and play into a company like Aussie Broadband?
Yeah, it was interesting the price reaction of that stock yesterday when they came out with their updates. They actually guided to the top end of their previous guidance. They said, look, profitability is quite good, but it's just all about their subscriptions. So people look at these companies like Netflix and these sorts of businesses, Amazon Prime, etc. Are you adding the customers that you thought you could add? And if you start to slow that down, we're going to absolutely crucify you. And I think they missed their ads by 2,000. So it was like 630 instead of 632 or something like that. And the market's just brutal about that. But you think, Aussie Broadband does seem to be winning market share. Yes, the market's becoming more competitive, we know that. But I would have thought the underlying demand for high-speed broadband and their customer service, continues to do quite well. I would have thought Aussie Broadband's probably been a little bit overdone on the back of that result, Scuddy.
I just wanted to ask about the gold sector as well. Being referred to as the naughty corner there by Peter O'Connor there at Shaw and Partners. We're seeing at the moment the US dollar is starting to go and soften. We've got bond yields coming down as well, including real bond yields. Is it time to go and have a look at the gold sector? Because it has been smashed over the course of this year. Yeah,
I think on valuation. So, how do you work out the value of a gold company? You take some sort of long-term nominal gold price and use a 5% discount rate or something like that and come up with a net present value of the business. I think both Newcrest and Evolution are trading around half their NPV on that basis. So that's pretty dramatic. It's normally you get some very short mine life companies that can trade significantly away from their NPV because they're very sensitive to changes in inputs. But both Newcrest and Evolution look like they've got significant years, if not decades, of mine production in front of them. I just think they're the big liquid names that are in the 100, and people have just decided they don't want gold in their portfolio. They think it's an inflation hedge they don't need to have anymore, and so you've seen some broad-based selling. But obviously Diggers and Dealers is on at the moment. Scuddy, you and I are probably a couple of the people in the industry that aren't at Diggers and Dealers. I think it's 2,500 people there at the moment, drinking beer and talking about exploration. But that's bringing attention back on these names. But I think, to Peter's point, they're trading very cheap and they're trading towards their 52-week lows. They're in the naughty quarter. They're definitely worth having a look at the moment.
Just to go and finish off, if we do go and see a pullback in interest rates that's sustained, any other parts of the market that you like at this point in time that they look fairly valued or even good value? Yeah,
we're at an asset allocation level, Scuddy, moved back to neutral. So we think the changing financial conditions that you referred to, i.e. bond yields are coming down, mortgage rates are coming down, credit spreads are coming down, etc. Money's getting easier and cheaper. So we don't want to be too negative. I think the probability of losses come way down on the equity market. Volatility is very low. It's very cheap to insure. So we're now sort of thinking about, is a recession already priced in to some sectors of the market? And if we can avoid a recession, surely that sector is going to do quite well. Now, the obvious one is discretionary retail. I was on here last week talking about JB Hi-Fi and Harvey Norman. The market's expecting their earnings to fall 30% from where it is today over the next couple of years. If we avoid a recession, that's not going to happen, and those stocks look really cheap. If you really, really want to play the sharp cyclicals, though, I think the building stocks are probably the place to look at. Not necessarily Aussie building stocks, but companies that are exposed to the US building cycle. We know that housing's turning down dramatically in Australia. House prices are definitely turning down. So I think Australia's tough, but I think the US, so you've got things like Reliance Worldwide and James Hardie, both stocks that are buy rated that we think are worth a look. Whether you buy them today or tomorrow, I'm not sure, but certainly if you think we can avoid a recession, that looks increasingly likely, that Hardie's and Reliance Worldwide look like interesting names to look at.